good day to all of you who've joined us in impressively large numbers from all over the world. I'm Stuart MacDonald, and I'm moderating this, the first of the Aaro Capital Thought Leadership series of webinars dedicated to distributed ledger technology, or DLT, and crypto assets. This series of educational webinars is designed for investment professionals rather than necessarily learner drivers to learn more about this fast-growing, fast-maturing space, which is still often and widely misunderstood, and the truly exciting investment opportunities that it presents. We know that there are a lot of truly serious investors, ranging from the likes of Fidelity to Paul Tudor Jones, who are taking an interest in this space, and Aaro Capital is the first player, to my knowledge, to enter it with a truly institutional quality multi-manager approach. This approach is very research driven, and this is reflected in Aaro's use of advisors like Daniele Bianchi of the School of Economics and Finance at Queen Mary University, London. And Daniele will speak of risk return trade-offs in crypto funds in about half an hour. But first, we're going to hear from Johannes, Gugl, partner at Aaro Capital. And what I'll say is that if you have any questions during the course of Johannes's presentation, or Daniele's for that matter, please use the chat function in order to put your questions forward. And with whatever time is available, Johannes and then Daniele will address these questions at the end of their presentations. I'll stress that if your question doesn't get answered now, if you make contact with Aaro subsequent to today's session, they'll be very happy to address those. I'll also suggest to you that if you're interested in having the slides being used today, these will be available through the handouts function on this webinar. Now, without further ado, over to you, Johannes.
Okay, thank you, Stuart. Welcome to the audience. So I want to directly start into our first session. In this first session of this webinar, we want to go into a little bit the current stage of DLT adoption, and to see also like how the industry and how the world is already progressing in its adoption. But then also like especially into the adoption of crypto assets in the financial industry, which shows also really significant increasing numbers and interest of institutional investors. Then also into the evolution of the crypto asset infrastructure, as we see that a lot of like professional players infrastructure comes into place, which really helps to the institutionalization of the crypto assets. And then finally, then also in the investment opportunities in DLT and crypto assets, which then also faces over to Daniele's part. So let's directly start in. So what we are seeing in the DLT and crypto space is a massive adoption of the industry. So like in 2019, we saw already an investment of 13 billion into this space, which sums up to more than about 50 billion in total investments over the last couple of years in this space, which is very tremendous, very significant numbers in terms of how the companies are adopting that. We will go into that then further. But after the first really wave of ICOs, that volume shifted more over to the venture capital space. That you see also a lot of like top VCs going into the space with big amounts, raising big funds like Andreessen Horowitz, Square Ventures, Sequoia Capital, Draper Associates, etc. PP. So we see more and more into that. That had also the background with the use cases, but especially those venture investors see if you compare it, when you compare it also with the age of internet, where really the big players came out like after the big wave. And I mean, like there are a lot of studies and surveys out, but I think a major one is also Gartner Research, which sums up the blockchain potential to deliver 3.1 trillion in value by 2030. So, but where is this all going in? We see like an extremely influx in money, especially in the banking, finance, insurance industry, but also in legal, cybersecurity, as well as, for sure, also supply chain, as well as healthcare and IoT topic. There are really a lot of interesting big use cases already going on when we look what Amazon is, for example, offering in their blockchain as a service solution, but also like the Bank of Canada, which has a clearing and settlement solution in place for stocks together with R3 and Accenture developed, or also like CME. I think it's also a very prominent example of their futures offerings, what they have. I think we all know about the Libra coin, but with the Tomos, what they currently have. But I think there are a lot of interesting other solutions in place, like HSBC with their private placement platform, where they have shifted a portfolio of 20 billion to their blockchain platform. Or as well as when we take out examples like Walmart, which is tracking their food supply chain on the blockchain, which is also very crucial in terms of like food safety. So there are a lot of interesting potentials out there. We just heard this week that PayPal plans to offer direct crypto purchase through their platform. And I think this is also something which will give the whole industry another big boost. So, but where is the money also going through? So we can also take like the newest study from Deloitte, which has made a survey of 1,488 senior executives in 14 countries, where we see also that it's not only anymore an interest into this field, it's like it's an institutionalization already into their strategies, what we see also further. So in total, like 36% of the respondents reported that they will invest 5 million or more this year into the blockchain technology, which is a significant amount also out of that. What we see especially here also is, for example, Brazil, Canada, but also Germany on the top of really big implementation projects and adoption projects in the blockchain space, but also all the others investing significantly in this space, like for example also US, which is a little bit below the global average, but there we see also that that America is taking into account the huge potential of the blockchain and DLT space. As I mentioned before, the Deloitte study has really identified that it's not really that thing that it is a future potential. It is already critical and in the top 5 strategic priorities of those companies. So that increased from 43% in 2018 to now 55%. This is significant. And you see also on the lower cases that this priority shifts more and more to a top priority of those companies. When we go a little bit deeper also, so where does the people see and where see this top executive the biggest potential? As you see, like in terms of the replacement of cryptocurrency or digital assets of fiat currencies, we see that overall more than 80% see that as the case that will happen in the next upcoming 10 years. And especially countries like China, but also interestingly Brazil or the UAEs, Singapore, Ireland. I mean, like those are the countries, or also Israel, which are very tech savvy, see it over the overall average of the adoption of cryptocurrencies and replacement of fiat currencies. But also in terms of like where the companies are working in, they are working a lot into digital currency space, but also data access, sharing, but also data reconciliation. Data reconciliation is such a big topic, for example, for big nationals, when we only see in the accounting system how this reconciliation or how much effort it takes in terms of data reconciliations only in their accounting systems, but also in terms of payment systems or track and trace audits, etc. Those are all use cases and the company is working and seeing the huge potential also of the blockchain technology. But there are also still barriers to enter. It's like really the implementation and the replacement of the heritage systems also, but also potential security threats, as well as like concerns of the sensitivity of competitive information, for example. So we see also overall, when you take a look at that, still also that there are some points and some barriers the industry still has to work on, and I think also a lot in solutions which are needed to fill that gap, I would say also. So a key outtake also of this Deloitte study is that the key takeaway from this 2020 global blockchain survey, which finds the leaders no longer consider the technology groundbreaking and merely promising, they now see it as an integral to the organizational innovation. So this has been mainly already institutionalized. So when we now go further into the adoption of the crypto assets in the financial industry, we see also a very interesting picture there out of the latest survey also conducted by Fidelity and the Fidelity digital asset space. So which showed already, for example, at a US investor base that that US investors who have an allocation into digital assets increased from 2019, 2020 from 22 to 27%. Out of that proportion, now 59% hold digital assets directly, as of like 55% in the last year. And more interestingly is that already 22%, up from 9% in the last year, have an exposure into the crypto futures market, which we see also on this. This shows also a lot of interest in the institutional adoption, that we see that already 4,000 separate accounts have traded Bitcoin futures since the launch in 2019 on the CME. This is a significant amount of and growth of institutional investors in the future space. As we see, also we have some peaks over times where the market was very active also, which is also happening this year, as we see. So, but why is it interesting? Why is it really appealing, digital assets for institutional investors? So also this study showed that 36% see it interesting because of the uncorrelated nature of the asset, what it has. We will also go further in that later. That is an innovative technology play. I mean, like, that is clear. We here really a once in a lifetime, or maybe a second in our lifetime opportunity as a technology play. Still, the high potential upside is very appealing also, but also like the decentralization is a topic also for institutional investors, what they want to further push, and also that it's free from government intervention. Arbitrage opportunities are also still there with a lot of exchanges, a lot of features, etc. existing, and but also like censorship resistance we see with 10% is also appealing to those investors. When we look also a little bit on the global perspective and Europe versus US, we see a little bit more interest in the price volatility, obstacles in the price volatility here for institutional investors in the US. So some see the volatility as an opportunity, some see it as a threat also. So the price volatility is still also a barrier for institutional investors to go in, but also concerns about market manipulation, lack of fundamentals to gauge an appropriate value, but also the security concerns by clients, the complexity, and the security concerns by institutions, which also relates to custody, infrastructure, and everything what we have in place there, where I think in the next slide we will give a little bit more overview what already happened in the crypto world in terms of trading infrastructure. So here we have a really good mapping also of the block, which shows what's happening already on the infrastructure side. So I think this is something for institutional investors to be aware of, that really a lot of people and specialists, professionals from the traditional industry moved into the market, developed new solutions for the crypto industry to really face like the lack what we had in the past, also in terms of like lending opportunities here, where we have a couple of examples, but also the derivative sides, the spot and liquidity market, the brokerages which fill a lot of liquidity in it, but also the market makers and more interestingly also solutions like clearing and settlement solutions or execution solutions. So I want to take out a couple of examples out of that, which are really, really interesting examples. So if we go in here, we see, for example, a paradigm which is also part of CoinShares, which is developing and really just released a RFQ trading platform also for institutional investors. Also Tagomi, which is offering an aggregator or trading facility, especially for professional investors. Falcon X, which offers automated OTC, sorry, there's OTX, OTC trading in that. Bquant, which has also quite of like a kind of complete solution in place with the exchange, with prime brokerage, with custody, but also with special crypto fund administration services they are offering. ErisX, also a very interesting example of a trading spot and derivatives platform, also for the for the institutional field. CCX, also on spot derivatives, X margins, also a very interesting example for especially the calculation agent settlement solution, which is really needed also for professional investors, for funds, also in terms of really settle their derivative contracts. GSR, a very interesting example also in terms of structured products. The team of GSR is working a lot also with funds to develop tailor-made structured products, hedging their risks also for their clients there. So a lot going on with the structured world. We see also other players going into the structured product world, where I think also the smart contract approach is really a reasonable solution for that, and also combined with the different Oracle solutions, which are increasing on different ends. Fireblocks and the custody thing. I think custody is a huge topic, especially for the institutionals. But we see a lot of technical improvements. We see a lot of add-on functionalities in terms of brokerage services, but also settlement, trading, clearing, etc. I think all those players, beginning with Fireblocks, Anchorage, with Coiny, they're working really hard on getting such solutions up, offering that to institutional clients and to funds, like also the funds we are investing in. So we see there a very, very significant improvement of the trading infrastructure. So this is really a hot topic, and I think also we will see much more developments on this side this year and over the coming years also. So when we're looking into investment opportunities in the DLT and crypto space, we're still talking about a very small proportion of the global assets. When we look into the 281 trillions of global real estate, the global debt market with about 250 trillion, but also the global money market with 150 trillion, global stocks with 85 trillions, and also gold with 10.4 trillions. Compared with that, the 250 billions where we are currently around in the crypto market, this is a tiny market. But as we see, the market is growing. I think the interesting thing is also that a lot of those, especially in the top hundreds, when you're looking at those companies and projects, they're starting or increasingly deliver also their solution. Also, in terms of use cases, we see a lot of going on. I mean, like we just have to mention Ethereum clearly, but also Cardano or Tezos, which launched their main protocol and their main nets, bringing more and more use cases on it. But also the Cosmos infrastructure, also the Cosmos protocol, see more and more adoption in that. So we will see definitely also that those companies delivering more value, but also like new players coming in, as we saw it just last week with Compound, which was listed, and with that also firing up. Maker, for example, the DeFi space currently, I think it has a lot of appealing and attractive developments there, which also helps the whole industry, going back to the slides before in terms of like the infrastructure, as those solutions are especially needed also for the professional field, also for leverage margin tradings, etc. So a lot of things are going on into the space also, which will further drive also the market performance. We see a lot of side movements currently, but overall, I think we all believe strongly in the growth of this asset class, and also that those projects are delivering more and more value in that field. So, so where is the investment opportunity in that? I mean, like, we still see that the crypto market has outperformed every other asset class over the last couple of years. Also this year, we see also that the crypto space, although it has an extreme decline over March, but recovered quite almost everything already now by June. But also like the volatility gives also opportunity in the space, especially for companies and trading companies and funds trading also on the volatility. So also that is a very interesting field where we are heading to, and where we have been already in the past. In terms of risk-adjusted returns, I mean, like, we see also that cryptocurrency beating other asset classes, but when we look into the Sharpe ratio with a 110, you know, like compared with a 0.61 on currencies, bonds with 0.21, equities with minus 0.001, real estates with minus 231, and commodities with minus 0.55. So we see also that the Sharpe ratio, which is a major measure also for us in the financial industry, is a really attractive measure in the crypto industry. Good. Correlations, other assets. That's also one point where institutional investors have a big eye on that, and I think that's one major thing also, that the whole crypto market has barely any correlation with other asset classes. When we look, for example, on the equity with a 0.07, or with bonds with 0.1, commodity with 0.8, or real estate with 0.6, and currency with 0.4. So this is really attractive also when we're looking into an overall portfolio of an institutional, of a family office, etc. That also helps not only in terms of performance, but also like improving your overall portfolio correlation and other KPIs you're measuring your performance. So yeah, to wrap that all up, I think we're on a stage now where the developments show really results. We see that in the DLT adoption space, we see it in the financial world, but we also see it in the trading infrastructure world. So the professionalism of the whole space is there, and we will go further in the next part then with Daniele, who dives in deeper into the performance of crypto funds. Thank you so far, and I hand over to Stuart.
Well, Johannes, thank you for such a thoughtful and intelligent talk, and a whole bunch of really interesting points there. There are a number of questions that I'm holding back until I see what comes through on the chat, and we've seen one from Oscar Pacey, which you can probably see. What is currently the best practice way to access the crypto space for professional investors who want exposure, but who also want to sleep at night? I think that's a fair question, given that in common with a lot of other people, at least until recently, I thought that blockchain was just a database and that crypto is a slice of the Wild West. And clearly it's all maturing at quite a fast rate. Would you like to address that, Johannes?
Absolutely. Thank you for the question. I think we will go further also then with Daniele's slides into that. I think especially for institutional investors, there are a lot of opportunities, but as long as you're not really into the whole topic for like 24 hours a day, because it's really an industry or a new asset class where you have to have a lot of knowledge about the tokens itself. I think the best way is really to invest into a fund which reduces the volatility and which let you sleep well at night. And I think that's the major part, especially when you don't like the volatility and don't want to see your assets moving like every day. I think a fund is definitely the best way for an institutional investor to step into the market.
Analogies could be drawn with what it was like when hedge funds were at the point where they were becoming mature enough for institutional investors or institutional grade investors to start going into that space.
Absolutely.
And multi-manager approaches proliferated quite rightly. I've got a question for you,
Sure.
very quickly, if you don't mind. When you're talking about the progress in this space, I mean, how much will this impact the crypto trading market and the performance of the traded assets?
I think that's also a very good question. I think, as I explained also during my presentation, the whole space is really improving, and it's really like that the projects are delivering. I saw also just another input from Jonathan here, DeFi with plus 50% growth over the last week. Yeah, absolutely. Thanks, Jonathan, also for that message here. And I think the main part is really that the projects are delivering now and increasingly delivering, and with that also the value is going up, because I think the value currently in the market is quite reasonable and will show more upside.
Okay. I think we will take advantage of the fact that we're running almost to the minute on time to move over to Daniele. The message I'm taking from this is that the space is still evolving, but it is maturing, and it's undeniable that we're seeing institutional interest in the space, and the trading infrastructure, which might have been a concern once upon a time, is truly coming together. You only have to look at who's getting involved in that from different angles. And I think that if one wants to take advantage of the investment opportunities in this space while controlling the risk and also grabbing the diversification benefits that it offers, then you probably do need still a pointedly institutional quality approach. And personally, I think that's where Aaro Capital's approach is interesting. But let's move on to our second speaker, Daniele, Bianchi. Over to you now. And I'll just repeat to everyone who's in the webinar that if you have questions for Daniele, he'll try and answer as many as possible towards the end. Put them into the chat. If you want to get hold of the slides or have any further questions, please get in touch with Aaro directly. And I'll just mention for your diaries, on the 14th of July, we're having the second in this thought leadership series. Anyway, over to you, Daniele, directly.
All right. So thanks a lot for having me, and thanks to Johannes and obviously Stuart for organizing this. Thanks to all of the audience for being here. So I'm going to talk about what is the risk-return trade-off in cryptocurrency funds. And I think the topic connects very well, first of all, with what Johannes said before, but it's also interesting on itself because there are obviously key institutional differences between institutional investing in the cryptocurrency space rather than in the, say, traditional equity space. If anything, you have huge market fragmentation, you have relatively low regulation as well, and almost no competition from cheaper investment vehicles such as ETF. On the other hand, the underlying phenomenon is the same that we've seen over the last decades in the equity market. So active management has been the default option for investors, essentially looking for external money managers since decades, at least until the first index mutual funds were available in the late 70s. So I'm going to dig deeper in this topic because I think it's one of the key elements that is going to characterize the evolution of cryptocurrency investing over the next few years. So I'm going to walk you through some statistics that show the evolution of the crypto funds landscape, and then I'm going to dig deeper into some original analysis that I made with some colleague in Lancaster University on the performance of cryptocurrency funds, and then I'm going to give you some takeaways at the end. So disclaimer, everything that I'm going to discuss, everything that I'm going to tell for the next 20 minutes is based on a recent research paper of mine that I wrote with Nicola Babiak, who is a colleague and friend at Lancaster Management University. I'm going to give you the details and the link directly on the paper at the end of the presentation. So, okay, so crypto funds landscape. So the reason, by the way, the reason why I mentioned that the source of the analysis, because one of the key things of Aaro, if I may, is that they are trying to merge the pure research academic aspect of cryptocurrency investing and the business one, obviously. And I think that's kind of a winning strategy, because on the one hand, this is a new space that you have to try to understand as much as possible. So they are merging the two aspects, which is really, really interesting and novel. So crypto fund landscape. So as Johannes was mentioning before, so the investing in cryptocurrency is growing massively. What I'm showing here, it's just a snapshot of this aspect. On the left-hand side, you have the number of funds in the data set that I'm using, and you see there is a clear, order of magnitude exponential growth of the number of funds over the last, say, couple of years, 2-3 years. And on the right hand side, you see that this is a global event. This is a global trend. So you see that funds are spread all over the globe. Majority is in the US, a large fraction in Europe, and obviously a large fraction in the UK and Asia, and some others in places, usual suspects like Russia, Brazil, and Australia. So the idea is that the cryptocurrency fund industry is growing in size, not just in terms of number of funds, but also in terms of asset under management, and it's a global trend. So it's spreading everywhere. Now, in terms of one of the key characteristics, if you wish, of cryptocurrency fund investing is that when you actually dig deeper and you break down the type of funds and strategy, you see things that are kind of familiar for everybody investing in traditional funds. For instance, when it comes to investment strategies, you see things that are familiar to the average investors, like long-short funds, long-term funds, market neutral funds, fund of funds, obviously, like the case with Aaro, and so on and so forth. So the question is there anything special of crypto funds? Not necessarily in terms of investment strategies. Those are things that we have seen, in other, more traditional asset classes. What is obviously peculiar, if you wish, is the institutional setting. So the regulatory environment, the competition environment, and the infrastructure they operate in. So when it comes to, so I said that there is a massive growth, there is an increasing growth of the number of funds, and that's a global trend, so it's basically spreading everywhere. But also in terms of asset under management, there is an increasing growth of the cryptocurrency, the crypto fund industry. What you see here, you see the asset under management of hedge funds in particular. And you see that in the space of a bit more than 3 years, the number of asset under management is order of magnitude higher at the end of the period than at the beginning. So now we are around. Actually, this is a little bit outdated data. Now we are well above 20 billion US dollars of asset under management. So it's increasing in number of funds, number of players, number of money involved, and geographically speaking, it's spreading everywhere. So it's a phenomenon that is massively increasing over time, and especially nowadays. So then the question is, okay, what kind of performances this type of funds have, and how can eventually profit out of those? So what is ultimately the performance of those funds? So I'm gonna give you, as I said, this is based on original research. So it's gonna be a little bit different, the shape of the slides in the presentation with respect to Johannes, but I think complements well. So what I'm showing you here is some very, very preliminary descriptive statistics. You see the average returns on the first column, when aggregate meaning the average fund, average hedge fund that invest in cryptocurrencies, and the average returns monthly is about 5.7%, which is pretty impressive. What is impressive also is the volatility. So if you look at the second row, first column, so standard deviation is also really high. And if you put those things together, you see that the Sharpe ratio on an annualized basis is something around 0.68% on an annualized basis, which is not necessarily stellar. I'm going to dig deeper, and I'm going to show you that this is just an average statistics, but you can actually profit a bit more if you look at, different type of funds. Now, the other thing that I want to highlight in this table is if you cluster, for instance, funds by type, and you can do that because they have not only different investment styles, but they also, they are by nature, they are different type of funds. You can classify, for instance, funds in hedge funds, so pure hedge funds, managed accounts, which are, sort of mutual funds, if you wish, and the so-called tokenized funds, which is a particular type of mutual funds that, you can invest in through tokens, basically. And the performances differ quite substantially. For instance, you see that the average hedge fund generates 5.4% on a monthly basis, whereas the average managed accounts has a much lower returns, but they have much lower volatility, which translate in a relatively comparable Sharpe ratio. You see, for instance, the hedge funds, they give you 0.7% annualized in terms of Sharpe ratio, while managed accounts are lower, but not massively lower Sharpe ratio annualized of 0.46. Now, when you look at the actual profit, so if you look at how the evolution of cumulative returns look like, then again you see there is a little bit of difference between funds and other sources of investment in the cryptocurrency space. So what I'm showing you here on the left panel is I'm just comparing the average fund, and that's the light blue line, the one with the highest return at the end, and I'm comparing that with a bunch of so-called passive benchmarks. So, for instance, a standard buy and hold on Bitcoin, a standard buy and hold in an equal-weighted portfolio of top cryptocurrencies, or a value-weighted portfolio of top cryptocurrencies, or an ETF. ETF is simply replicating, for instance, a value-weighted portfolio of the cryptos that can be that are currently tradable on Coinbase, which is one of the major cryptocurrency exchanges. So you see that there is value, at least nominally, on average at least, in investing in funds, because towards the end of the sample, you see that a simple $1 investment in March 2015, would deliver a stellar $70 return by the end of the sample, right? And that's pretty impressive. While if you invest in other more passive, obviously cheaper, but passive benchmarks, so not necessarily complex strategies, you may still make quite sizable returns, but certainly less than investing in crypto funds, at least on average. And if you dig deeper and you look at the right panel of this figure, you look at the difference between, for instance, hedge funds, managed accounts, and tokenized funds, you see that all of those, to some extent, they tend to perform along the same lines, although, for instance, hedge funds, they tend to give you a little bit higher cumulative returns toward the end of the sample. So all in all, the reason why I showed you the table before in this picture is to just give you the idea that on average, if you pick the average fund, there seems to be evidence of pretty good returns, right? As even if you adjust for volatility to some extent. Now, there is obviously heterogeneity. When I say heterogeneity, is that not all of the funds are alike. So if you take the average performance, it's true that there is a good performance of the funds, but that's not necessarily true for all of the funds. So what I'm showing you here is on the left panel is the average, cross-sectional distribution of the average returns. So the way you construct this graph, you take the average return of each of the fund in your sample, and then you look at the distribution across all of the funds. While on the right-hand side, I show the same thing for the volatility. So I just calculate the standard deviation of the returns on a monthly basis, and I show how that standard deviation behaves in the cross-section of funds. So you see two things. On the left panel, you see that there is massive returns, and although the average returns is not, it's high, but not massively high, you have funds, if you look at the right tail of the distribution, that deliver, something like 30% on a monthly basis, which is, obviously impressive. Those funds obviously tend to have high volatility of the returns, and that is shown on the right panel. When you look at the volatility, you have funds that, they have 60, 70, 80% volatility of returns on a monthly basis. And then if you put those things together, they give you the Sharpe ratio. And what I'm showing you here is that, okay, even if you control for volatility, so even if you take the ratio of returns on volatility, you still have Sharpe ratio that you don't see, at least nominally, you don't see in any other traditional investment, in traditional asset class. You can basically forget to have a Sharpe ratio of 4 on an annualized basis investing in equity, say. Now, the last thing that I want to mention is the skewness of the returns. So one of the key aspects of the returns on the funds is high returns, high volatility, so relatively high Sharpe ratio, but not massively high. But also you have positive, the higher probability of large gains than large losses, which translate in positive skewness. When I say skewness, literally mean from a financial perspective, is the probability of having large gains, it's higher than the probability of having large losses. That translates in a positive skewness, as I just said. So, so if you put together this thing, the picture that emerges is that, okay, on average, you have a good performance, but there is a huge variation across funds. So you have to be careful at the end of which type of fund you're looking at. And ultimately, the question that everybody's interested in is that, okay, can crypto funds that can generate ultimately invest value for the retail investors, if anything? So what I'm going to do, I'm going to dig deeper into the data, and what I'm going to do next is basically try to show a bunch of statistics that are going to compare the funds performances against passive benchmarks, so cheaper investment strategies, if you wish. And in particular, I'm going to consider 4 strategies: a buy and hold investment in Bitcoin, a buy and hold investment in Ethereum, a value-weighted portfolio of the digital assets that are currently available in Coinbase, and I call that ETF, and an equal weighted portfolio of the top 300 cryptocurrencies sorted by market cap. And these benchmarks, to some extent, represent, they are representative of a variety of different passive, cheap investment strategies that are available out there. So, just to give you an idea of some of the results. So what I'm showing here is the alpha, basically. So I'm going to take the returns on the average fund. I'm going to take out the exposure to the different benchmark passive strategies, and then I'm going to see what is left effectively. So what you see is that an average, the alpha of a crypto fund is about 5.4% on a monthly basis, and is obviously statistically significant. And basically, like I showed before, when we were looking at just standard raw returns, there is huge variation if you look at hedge funds versus managed accounts versus tokenized funds, for instance. So there is variation in according to the type of fund you're going to look at. So it seems, and this is a little bit of a provocatory question that I ask, since there is some value in investing in crypto funds, but the idea is, can you really disentangle the skill of managers by luck? Because it could well be the case that some of the managers massively outperform a passive benchmark strategy simply because it got lucky in the crypto picking, if you wish. So is there a way you can disentangle these two things? Well, there is a statistical procedure that is called bootstrap, through which you could disentangle, or you could look at what could be the performance of a fund if that is just generated by luck, and you compare that performance with the actual performance of the fund. So you can see what is the difference between a simple manager that has been lucked throughout his history and a manager that actually deliver the performance. So, and that's exactly what I'm showing you here. So you see, just focus for a second on the left panel, and the left panel show you you see these light red bars. That's basically the cross-sectional distribution of the alphas if there is just luck involved, so no skill at all, while the light blue bars are the actual ones, so the observed alphas. And on the right-hand side of the figure, so the right panel is basically the statistics of those alphas. So it's a rescaled version of the alpha that takes into account the volatility. But if you just focus on the right panel, you see two interesting things. First of all, and no surprise, given what I showed you before, there is huge variation in the alphas that are generated by the funds. Second thing, if you look at the overlapping between the blue bars and the red bars, you see that there is a massive higher mass, probability mass, on the funds that generated alphas through skills and not luck. That basically tells you that there is some skill involved, and the performances of the fund is not necessarily just generated by luck, but in fact there is skill involved, and that skill generate performances. Now, the last thing that I want to mention, since I think I'm running a little bit out of time, I guess. So one of the things that actually can be brought up is that, okay, there has been the so-called ICO bubble until the end of 2017. In fact, until December 2017, they basically drove up all of the prices, and it was relatively easy back then to make money running a fund. So the question is, what would happen if you start out the funds at the peak of the bubble and actually you take all of the downward trend after December 2017? And that's one of the key questions. Now, what I'm showing you here is that, in fact, some of the performances remain intact. Obviously, you see that there is lower performances in general. So the alphas becomes smaller, but the alphas are still there, especially for a small fraction of funds that turns out to be profitable also in a massively downward trending market. So let me give you some takeaways here. So the main takeaway, which I think is relevant, not only from an economic perspective, so being an economist, but also generally speaking for the businesses, is that not all the funds actually generate value for the investors. In fact, a small fraction of them do. And then the obvious implication is that ultimately you want to be able to select the right fund manager, and that's a key thing for a successful investment strategy. Obviously, that's obvious from a first perspective, but that's not necessarily obvious if you look at the conventional wisdom that posits that basically everybody can make money investing in hedge funds. It's not necessarily true. You have to be careful and pick the right funds. So the original research paper is available online, and I put the link here if you click on the here blue thing. And obviously, I'm open to any question. Thank you.
Daniele, that was really interesting, and thank you. As with Johannes, a lot of interesting points, a lot of food for thought, and we are getting questions in, a couple of which I'll suggest that you should address. And if anyone has further questions, put them into the chat column as soon as you can. We have limited time before the end of this, the first of our series of thought leadership webinars. If any of you are interested in getting copies of the slides that have been used, use the handouts column. Look at the handouts top right of the same section that has chat that you'll see on screen, or contact the people at Aaro to get the slides to you. And I'll repeat that if any of you want to find out more about the space or about what Aaro are doing, contact Aaro, let them know about it. But Daniele, I wonder if you wouldn't mind looking at what Oscar Pacey has asked. There are a couple of questions that you might be able to deal with as a single one. Does the performance of funds persist over time, or is there volatility in the benchmark adjusted returns? And how do you see crypto funds in a broader risk diversification context?
Well, these are two interesting questions. So what we find in our research is that, in fact, there is persistence over time about the performances. So those managers that are, good in performing, they keep doing well, even, 1 year ahead, say. So there is performance, which is not due to luck, that persists over time, obviously. Now, to the second question, how do you see the crypto funds in a diversification context? This is a relatively tricky one, and we are planning to address this in further research. But preliminary results shows you that you get the same diversification benefits as cryptocurrencies. So there is relatively low correlation between returns on a given fund or a pool of funds and other asset classes, which ultimately benefit in terms of diversification. So in fact, I feel pretty comfortable to say that there is some diversification benefit in putting some of your wealth in crypto funds at the end.
Oh, that's certainly one of the first things that began to open my eyes to this space. I hadn't realized, and I think that's not commonly known, that this space does not have very significant correlation at all with other asset classes, even alternative as opposed to traditional ones. I see another question from Alex Dickerson. I think this is at the level of individual strategies. Is there any difference in the performance of funds based on their investment style or strategy? Do you want to pick that up?
Yeah. Yes, there is. Obviously, there is some differences. In fact, you see that the best performing ones are the long short and the long term investment strategies, and the one with the lower volatility are the market neutral funds, as you should expect. So there are differences in the cross section of fund returns and in performances. Now, we can't really pick up names in our research because that's an academic research, so you just can't. But there is, yes, so there is differences in the performances based on their investment style and strategies.
Okay, and it was interesting that, I see another question, and this also, this could be open to Johannes as much as you. Just something that came in earlier about regulation. What is allowed and, as it were, touchable by institutions? That came from Jonathan Lamas or Yamas, and that seems to dovetail with what Andrew Kent asked. When will these type of funds be open to retail investors with smaller amounts to invest in than institutional players? If you want to pick that up.
General to answer that, regulation, it's always like a topic like what institutionals we're talking about. Do we talk about a family office? Do we talk about pension funds or endowment funds or something like that? So I think especially in countries like Switzerland, but also like in Germany, we see more and more banks moving into that space with really trading solutions, custodian solutions, etc. I think Germany is really even heading there ahead of Switzerland, what I'm seeing, but also depends on how they classify, because different countries classify also the cryptos differently, either like as a cryptocurrency, as a commodity, etc. So that depends then on that. But I would say I think also in Switzerland, so for example, we have the opportunity of certificates, for example, but definitely they can trade in the top cryptocurrencies. And but as I said, also especially institutional investors, I would recommend rather to go into a fund structure in a fund which is also regulated to be secured. And we're seeing also more and more actions in terms of like exchange traded products, for example, and which is also an interesting space. And going back also to your questions, I think the real retail funds besides like the index funds, etc., that will take a little bit more time, I would say, but the institutional grade funds are paving the way forward, I would say.
And I think it's good that this question about regulation and even about retail access to this sort of things come up, simply because all of you on the webinar will note that the second slide is a regulatory disclaimer. It's not just there for show. Anyone is welcome to participate in the webinar, but we should make it abundantly clear that the webinar is designed for professional investors. If you are not regulated or deemed by the regulators in the country where you live to be expert, qualified, professional, or some equivalent, you really should not take. You should not act on the basis of what you hear in the context of this webinar. You do need to take independent professional advice of some sort. Sorry to be dull, but we should be careful about that kind of thing at all times. This is, we really are addressing this to professional investors, if you will.
Do we want to take another question from Andrew? I think that's all.
This question about what's the advantage of using a crypto fund over simply buying and holding crypto directly, that came in earlier, I think is a very fair one.
Yeah, I think we can share that. But do you want to take that, Daniele?
Yeah. I think the easy answer is that you get higher returns. So what we show in our research is that if you just take a standard buy and hold approach in a basket of cryptos, or just simply Bitcoin, say, or even in a market index, you're going to underperform the average fund. So that's even adjusting for volatility. So the short answer is that, in fact, there are funds that can outperform a simple investment in cryptocurrencies. So yeah, from a profit maximization perspective, the two things are not exactly the same thing.
I think to add also, I think what's interesting in the whole landscape is the different strategies also, and it's also a little bit a belief in like what works out. Like, do you go more into like an arbitrage fund in terms of like market neutral, a little more in long short, you look more in fundamental venture kind of style when you believe in like the long-term growth. We're all looking in, and this is why also we have to approach with the fund of funds, to cover all the different strategies also, and make them the rebalancing on that.
I mean, finally, given the limited time available,
all right.
First Daniele and then Johannes, in one or two sentences, if you wanted to go back to the notion of takeaways, what's the most important message you would give to the people on this webinar? First Daniele and then Johannes.
Yeah, on my side, I think the main takeaway from our research is obvious, which is you have to be careful in the funds you pick, because despite nominally the stellar performances that most of the funds advertise, is not necessarily true that all of them are worth it. They're actually not all of them, they generate value for investors. So ultimately, you have to be careful in the fund that you pick, and that's where possibly professional players can come in and help.
Of course, I mean, you talked about the persistence of sound performance amongst those funds that perform well. However, finding them is not that easy. They're geographically diffuse. There is nothing like perfect information in terms of what's available. I'm very aware of that. And the distribution of the dispersion of performance is really, really intense. There's a question that's come in a little late about hedge funds, which we don't have time to address. I just want to ask you, Johannes, to give us your one or two very quick takeaways, and then I'll wrap this up.
Sure. I think a main message out of that is that the market is overall extremely maturing. It starts really with the applications, with the protocol layer, but also with the application layer, with the trading infrastructure, but especially also with the funds. So we see that it goes away from those like lucky shots VC funds to really professional people, to professional setups. This is also where we have a big eye on that, that not only like the performance and the risk management works, but also that the governance structure is in place, the compliance is in place, that we're dealing really with professionals who understand the market, who understand the trading behind it, and who understand also managing the risks in terms of like the investment risks, but also in terms of like the operational risks. And this is also what I want to give as a giveaway to all listeners, attendees, is like not only looking on performance, also looking really on the downside protection, and looking on the professional setup of a fund.
And yet this process of increasing maturity at all sorts of different levels has not reached a point yet where the opportunities for smaller players to enter the market are not there. We haven't reached that point yet. We haven't reached the point where the opportunities for super returns are no longer there. They haven't been traded or arbitraged out of existence. There are tremendous opportunities, but you're right. Because the process of maturation is not complete, you have to pay an awful lot of attention to the operational due diligence side of the equation, as opposed to simply looking at whether something in investment terms works. I want to thank both of you for
thank you.
Being so blooming interesting and informative. Want to thank Aaro Capital for giving me the opportunity to participate. Want to thank everyone who's participated in the webinar as audience for coming in. If you haven't picked up the slides already via the handouts function on screen, get in touch with Aaro if you want to find out more about what they're doing. And it is interesting because, in my view, it's the first institutional grade activity of that type that I've seen. Get hold of Aaro directly and look out on your LinkedIn and your other sources of information for the next webinar, which is on July the 14th. That will feature Aaro's CIO, Chief Investment Officer, Ankush Jain, and another of Aaro's academic advisors, Spiros Galanis, and hopefully they'll be able to amplify our understanding and deepen it of this very interesting space. On which note, I'll bid all of you have a very happy rest of this day. And do get in touch with Aaro if you want to know more.